So when you're wanting to trade with options, it's always best to trade stocks that have great volume. The stocks with higher volume have higher liquidity, and the higher liquidity, the more you're able to get in and out of a trade very efficiently. These could be stocks like Tesla or Amazon or Google, but those stocks are usually going to be hundreds of thousands of dollars for you to be able to enter one single position. So it usually knocks out a bunch of people with small accounts to allow them to not trade it. But there's a way that you can trade those kind of tickers, and that's going to be through debit spreads. I'm going to teach you everything that you need to know about how to trade them in this video. What's up, guys? Welcome back to Modern Options, where I'm here to teach you how to trade options to create a better quality of life. If you're looking to open up a new brokerage account with either Robinhood or Webull, I got a couple links down below where both you and I can get some free stocks if you sign up using my link at no additional cost to you. Before I go any further with any of my videos, it's worth noting that you're able to practice any strategy that you learn without any risk at all. You're able to do this with paper trading, just meaning you're trading with fake monopoly money. I highly recommend that you do this before putting any of your own money on the line, because not only does it allow you to nail down certain strategies that you just learned, but it allows you to become familiar with the trading platform before using your actual money. So the one that I'd recommend is going to be TD Ameritrade software, Thinkorswim. And there's two ways that you can use this, and you can either go to their website and sign up for a free 60-day trial, and that doesn't require you to have a TD Ameritrade account, or you can just sign up for a free account, and then have unlimited access to paper trading. So I actually never even traded on Thinkorswim for the longest time. I just used it for its charting and screening software and executed my trades on Robinhood. So after you create your account and download the Thinkorswim application, you should notice a toggle bar on the login screen, and that should be able to flip to paper money. So you're going to use your same credentials and then log in, and you'll know you're in your simulated account if up at the top left corner you can see the words PM standing for paper money. Now you're able to try anything with no risk, and if you mess up, you can just reset and try over again, and before you're actually ready to put real money in. So debit spreads. You're going to need to be at a margin approval for your broker to trade these. I believe it's tier 2 margin for TD Ameritrade and then level 3 for Robinhood. And then to be approved for that, you're going to have traded at least a few single leg options first. I went over that in my previous video, and if you haven't checked that out yet, you might want to just pause this video and go back and watch that one first. So the two main types of debit spreads are going to be a bull call debit spread and a bear put debit spread. You're going to make money in a call debit spread if the underlying goes up, and you're going to make money on a put debit spread if the underlying goes down. I'll give you an easy reference chart at the end of this video, and it'll kind of help depict the difference between the two types of spreads and show your profit and loss. A debit spread receives its name because as a result of the two-leg option order that you place, it results in a net debit, meaning that you will pay to enter the spread, and then you'll receive a credit back when you go to close the spread. How a debit spread works is that you will buy your long strike and then sell a short strike that is above it for a call or below that for a put. An easy way to know if you're choosing the right strike is that the strike that you're selling should be cheaper than the strike that you're buying. And you can be as speculative as you want with these in a debit spread, but to be safe, you're probably going to want at least your long strike to be in the money or right at the money, and then sell your short strike at the point you believe the stock will be above by the time of expiration for a call, or where you think it'll be below by the time of expiration for a put. The more in the money that you go, the more you're going to pay up front, but the safer the play is going to be. So just less risk, less reward. And the further out of the money you go, the cheaper that play is going to be, but you're at greater risk that you lose your money. More risk, more reward. So you have to find what's best for your trading style and how speculative that you want to be. The act of buying one option and selling another allows you to trade really expensive options for a fraction of the cost. I'm going to show you how to place the order on Thinkorswim first and then on Robinhood. Those are usually going to be the two most common brokerages that I see, along with E-Trade and Webull coming in close second. Thinkorswim platform is a little bit harder to get used to compared to Robinhood, but you're going to thank yourself later for learning a complex platform up front. And also, I just definitely recommend having at least two brokers for a few reasons. So you get to artificially break that pattern day trading rule by being able to use 6 day trades within a given week. If both of your accounts are under 25K, that's going to allow you to trade 3 different day trades in each of those accounts, a total of 6. So that way you don't miss out on any market opportunities if you've already used up all of your day trades. And also, if one brokerage is going through some server issues, you could execute the trade that you want to do on the other one. So again, you don't miss out on any opportunity that presents itself. I'm not going to do a full breakdown of the entire Thinkorswim platform because there's just seriously way too much to cover in one video, and I don't even know every feature that the platform has. But TD Ameritrade themselves have plenty of tutorials directly on the website on how to use their platform, and once you sign up for a TD Ameritrade account, they even will send you emails once in a while about a webinar workshop that they'll host with live instruction, and it's free $99. So be sure to check that out. So I'm going to go ahead and show you how to create a single leg option order on Thinkorswim. So once you've logged into your software, go ahead and hover over to trade, then all products, and then type in the ticker that you're trying to trade. So I'm just going to go ahead and do it for Palantir. And then you're going to want to open up the options chain and then select the expiration that you want to choose. I'll go ahead and select 19 Feb. And you'll notice the options chain, the calls are on the left and the puts are on the right. And then you can customize your data fields to anything that you want it to be in this layout right here. So I have net change, the open interest, volume, the delta, the theta, the current mark, bid, and the ask, and that's on both sides. Any options contract that's in the magenta color, that shows that that call or that put is already in the money. Anything that's black is out of the money. So let's say I wanted to buy the $30 call strike, 19 Feb. I'd hover my mouse over the ask price, which is meaning that a seller is willing to sell that contract at $4.15. Go ahead and click buy. It's going to pop up down below where you're just looking to confirm and send. So you just click that, and then you can either go right at the market order, right where it's at, or just if you're hoping for a little bit of a pullback, push it down a little bit and hoping that you get a better price entry, and then confirm and send, and then you're good to go. But this is about debit spreads, so we'll go ahead and get into that. So the reason that a debit spread is more cost effective to enter is because the price of your long contract is lowered by the amount that your short contract is worth. This should result in a positive number, meaning that is how much you'll need to pay to enter into the trade. You can make your strike choices as close or as wide as you want. I'll make a future video showing some of my favorite stocks to trade that have a really small strike price spread from like 50 cents to $1, which would really help out for those with smaller accounts. So looking at Palantir, I'm going to make a debit spread that's $2 wide, say the $30 strike and the $32 strike. So to do that, you're going to first need to click on the ask for your long strike, for me is 30, and then to do a multi-leg order, when I go down to 32, I want to sell to open that one. So I want to hold control and then click on the bid. That's going to allow you to put in 2 legs of an option order. So at the time, you can see down here that's resulting in a net debit of 83 cents. And it's a $2 wide strike. So $2 minus 83 cents, that means that the maximum amount of profit that I can make off of this trade is $1.17. And my max risk in the trade is going to be only what I put in, which would be 83 cents. The max profit's really easy to calculate. You just take the width of the spread, which you just subtract the 2, so 32 minus 30 is 2. So that $2 minus 83 cents gives you that $1.17. The price of the spread can never be any more or any greater than the width of the spread. So in order for you to make the maximum profit that you can on the trade, Palantir would have to be trading higher than $32 by expiration. So that would mean that both of these contracts would be in the money at expiration and would be exercised. So you would essentially be buying 100 shares of Palantir at $30 and then immediately selling it for $32, which nets you $2. So this is really going to help you fight greed by having a limit to your profit. You're going to be able to cut out of the trade with a solid price target, knowing that there's no more room to grow. So here's an example of what a called debit spread profit and loss model would look like. So this bottom line here is flat because no matter how much lower that the stock goes below your long strike, which is right here, you won't lose any more money than you put in. And the line is also flat on the top because you sold that call, so no matter how much higher the stock goes above that strike price, which is the one you sold right here, you just will never make more money than that. So one thing to take into consideration, you might ask, well, the stock rose way above my top strike price. Why is it not telling me that my spread is at full value yet? And that is because time, my friends. all the extrinsic value on your short option is working against you, and the only way for that to go down is for time to work its magic and have that extrinsic value eventually go to zero. It's either that or the stock would seriously have to blow way past your short strike in order for you to gain that much value that it would be worth it to lock it out with profit. So what does this mean? Don't always expect to receive 100% maximum profit on every single trade. Matter of fact, I don't think I've ever actually held a debit spread that close to expiration to realize the full value. I usually just close it ahead of time and lock in my profits. And you usually only have to sacrifice about 10 to 15% of your maximum value. It's probably just best practice to close your positions if they already have anywhere from 70 to 90% of their full value realized. But again, that's up to you, and trade at your own personal price targets that you set for your trade. And then here's a quick example of the put debit spread profit and loss model. Same thing as the call debit spread, except just opposite. And if you're on the Robinhood platform, you're just going to go to buy call, hover over your long strike, click that plus button. You'll see it populate over here. And then go ahead and sell your short strike, so that same 32. And you should see up here, it's going to reflect that you're making a call debit spread. Then you'd click continue, enter how many of those contracts you want to do, and put in your limit order. So that's all the info that you should need to know to get into some debit spreads. So here are some few of the pros and cons in review. So pros, it requires less capital for you to enter into a position due to you buying and short selling an option simultaneously. And then it also is going to protect you having a lower theta decay. So since theta decay will benefit the short call that you sold to open, this helps you offset the amount of theta decay that you will lose on your long strike every day if you hold the position overnight. Along those same lines, if your play goes against you, the amount of money you lose will not be as drastic and it won't fall as quick because, again, that short contract that you sold is going to gain value for you whenever that price decreases. Another pro is it helps you fight greed by having that maximum profit ceiling. And that's also part of the cons because your gains are limited and capped due to that short strike that you sold above it. So why would you want to enter into a position where your profits are capped? Wouldn't you just rather buy just a straight call or a straight put? Well, maybe. While you definitely can make more money from a straight call or put in a shorter time period, which is good, but that type of position has a much higher risk profile and you'll lose a lot more of your value very quickly if your play goes against you, or if it just doesn't move at all, which is bad. So that wraps up all the info you should need to know on what a debit spread is and how to enter a position. If this video helped you out at all, I'd really appreciate it if you liked the video and spread it to more viewers. If you have a friend that wants to get into options, share it with them. I'd love to help them understand options better. Leave a comment below if you want any more clarification on anything I discussed. I'm putting out videos every week, so make sure you subscribe so you don't miss out.